Hi, I'm John Nicholas. This video covers considerations for converting your regular IRA to a Roth. First, let's review the main differences between a regular IRA and a Roth IRA. The amount you contribute to a regular IRA can be deducted against your earned income for tax purposes, with certain limitations. For example, assume you are married and filing taxes jointly, your combined gross income is $100,000, and you contribute $7,000 to your IRA. The $7,000 can be deducted from your $100,000 in income, and you are only taxed on $93,000. The $7,000 tax deduction is the government's incentive for you to contribute money to your IRA for your retirement. The government comes back for its taxes, however. For a regular IRA, money withdrawn is taxed at your ordinary income rate. In addition, you are required to take minimum distributions beginning at age 72. In contrast to a regular IRA, contributions to a Roth IRA cannot be deducted against ordinary income. You make Roth contributions with after-tax dollars. That is, income upon which you have paid tax in the current year. For example, again, assume you are married filing jointly, earn $100,000 in income, and have $75,000 left after taxes. You might contribute $7,000 of the $75,000 to your Roth IRA. Another difference compared to a regular IRA is that for a Roth, the money you withdraw is not taxed. This is because your Roth contributions are made with after-tax dollars. Additionally, for a Roth, there is no required minimum distribution at any age. The logic here is that the government is not concerned about when you take the money out because your contributions were made with after-tax dollars, income upon which you already paid tax. As you can see, one significant factor in deciding whether to contribute to a regular or a Roth is your tax rate at the time of contribution and your tax rate in retirement when you would be withdrawing money from your IRA. For a regular IRA, the most attractive scenario is making pre-tax contributions when you are working and are in a high tax bracket, and then withdrawing funds from your IRA when you're in retirement and in a lower tax bracket. For a Roth, you pay tax today and then have an asset that appreciates tax-free for as long as you want, and any money withdrawn is not taxed. So a Roth works well for someone who is likely to be in a high tax bracket in retirement and who wants to compound assets tax-free well into retirement. To recap, the main differences between a regular and a Roth IRA: for a regular IRA, tax-deductible contributions and money taken out is taxed at your ordinary income rate. For a Roth, contributions are made with after-tax dollars and amounts withdrawn are not taxed. Should you convert your regular IRA to a Roth? Again, tax rates now and in retirement are important parts of the calculus. Another key consideration is when you might need the money from your IRA. If you think you will be in a high tax bracket in retirement and will likely not need the money early on in your retirement, or maybe not at all, then you may be inclined to convert to a Roth so that you do not have to take minimum distributions and your money can compound tax-free for the longest time period possible. In addition, you may consider converting all or part of your regular IRA to a Roth during market downturns, when the value of your IRA declines in value. A Roth conversion is a taxable event. You pay taxes on the contributions you made to your regular IRA if you deducted them, and you pay tax on any growth of the assets. There is an advantage to doing a conversion during a market sell-off when assets have depreciated, because you pay less taxes upon conversion. Once invested in the Roth, any appreciation in the assets, such as due to a market rebound, will be tax exempt. And as noted, there will be no tax on amounts withdrawn. You may also want to do a Roth conversion in a year when you have a dip in your income, because the amount you convert increases your taxable income. Converting to a Roth in a year when you earn less income is advantageous because you will likely be in a lower tax bracket. This may also be the case when you retire and your income is lower and you are in a lower tax bracket. Keep in mind that if you do convert a regular IRA to a Roth, you will need to come up with the money to pay the extra tax related to the conversion. You should also be aware that, with some exceptions, a person inheriting a regular or Roth IRA must withdraw the assets from the IRA within 10 years from the date of death of the person they inherited it from. For example, a child inheriting an IRA from a parent who passes away in 2021 must withdraw the full amount of the IRA by 2031. This new requirement raises a host of estate planning and tax issues for the person with the IRA and for those inheriting it, and does affect your assessment of converting a regular IRA to a Roth. Converting all or part of your regular IRA to a Roth relates to your current financial picture, your retirement plans, and your tax status now and in retirement. If you have questions about converting your regular IRA to a Roth and would like a complimentary analysis of your specific situation, I would be happy to talk with you. Thank you.